going? Before we get into this video, NQ Stats does not provide strategy. It does not provide indicators, and it does not provide investment or financial advice. What NQ Stats does do is provide statistical edge derived from historical market performance. Nothing shown in this video should be taken as advice of any kind. This video is providing a tool that could potentially be leveraged to make a trade decision. You as the trader are responsible for how you leverage and build around it, in addition to how you enter, exit, and manage any trade you decide to take. With that said, let's get into it. All right, how's it going? This video is going to be on the ALN Sessions. We're going to look through some examples. We're going to go over the stats themselves and just, figure out how to utilize this, right? So the information's on the website. We'll look at the website real quick, but this video is going to be sort of a more detailed overview with some examples. So ALN Sessions refers to the Asian, London, and New York markets. Now, other people might define these differently in terms of time, but this is how I define them. So the Asian session, it utilizes the actual Asian market hours, which runs from 8 p.m. Eastern to 2 a.m. Eastern. Simple as that. Now, the London session technically runs from 3 a.m. to 11:30 a.m. Eastern, but for the purpose of these stats, I run it from 2 a.m. to 8 a.m. Reason being is that much like the New York session, pre-market traders come in around that 8 o'clock time. You have the 8:30 news. You have a lot of positioning around that 8 to 9 o'clock window. And those are your New York session pre-market traders. London has pre-market traders as well. If you watch volume, a lot of volume starts to come in around the 2 a.m. up until that 3 a.m. open. So I classify the London session for the purpose of this stat as 2 a.m. I run it to 8 a.m. Specifically because that's when I pick New York up. And then New York just runs to the standard 4 p.m. close. All right, so Asian, London, and New York session times. Now getting into the four components of this, you'll have London engulfs Asia. That's where London takes both sides of the Asian market. What will New York do, right? You have where Asia engulfs London, so the opposite. London will trade and it stays inside the Asian market. What will New York do? This does not happen often. Over this sample period, 10 years, from 2015 to 2025, this has only happened 168 times out of 2,490 trading sessions. So it does not happen very often, 7% of the time. Should not be really something you expect to happen. But if it does, or when it does, I have the stats for that. Next will be London partially engulfs upwards. So when the London session takes the high of the Asian session, but not the low. And then inverse to that, when the London partially engulfs downwards, the London session takes the Asian session low, but not the high. So getting into examples of seeing this on a chart, we'll just erase these circles here. And this will go back, let's see, where are we at time-wise? This goes back to January, so pretty much all of 2025 so far. We'll just go through the charts and see if we can find some examples. So here is an example of the Asia engulfs London, right? So Asia trades wider than the London session. London trades inside Asia. What can you expect? You can expect 74% of the time from the historical data, 74% probability that the New York session will take the Asia high. So it will take the red box high. 63% probability that it will take the red box low, and 42% that it will just take both sides, engulfs both sides. So going into this day, New York session opens up, it runs up, takes that high. So that high, again, had a 74% probability of getting taken. Now that the high is taken, expecting this low, so expecting this low, now that this high has been taken, the expectation is not to see the low. Yes, it does happen here, but that low getting traded through, there's only a 42% probability of that. So while it did happen on this particular day, it's not high probability. It would not have been my expectation based off of historical data. and it would not have been probably a trade I took. Now, if somebody else has a different model that trades that, great, but from a statistical standpoint, low probability that that gets hit. So that was a Asia engulfs London. Let's see if we can find a London engulfs Asia. That's a London engulfs Asia. Maybe, let's see, there's another one. And maybe there's one more recently. There's another one. All right, so we got 3 just within, within the January time period. When we're looking at Asia, or London engulfs Asia, that's when London engulfs both sides of Asia. What are the probabilities? So 80% probability that the New York high, or that New York session takes the London high or the London low. So blue box low or blue box high. 80% probability that one of those will get traded through. 64% probability that both get traded through. So going into the New York session, right, this is all you would see, both sides. London takes both sides, and now you're bouncing up here. You're kind of back into the middle of London. Your expectation is this high and this low. There's an 80% probability that one of those will get taken. There is a 64% probability that both of those will get taken. So New York session opens up, and let's see what we got. We start to pivot, and it takes the London high. So 80% probability. If this pivoted up, and I'm not going to get into strategy or specifics of how you would trade, but there's some gaps here. There might be some ICT-ish order blocks if that's what you trade. There might be some oscillator signals here if that's what you trade. There could be some supply and demand zones here if that's what you trade, based off of these highs over here. All kinds of stuff that you could get long on this. Not going to go into strategy, but let's say you take a long somewhere in this area. You now have a expectation from a probability perspective of running to this high, right? Now, after you take that high, maybe that's a scale out, maybe that's a full exit. I don't know. If I was long somewhere in here, running to this high at 715, I mean that's over 50 points. I'm probably fully exiting, taking my money and walking away. But perhaps that might be a scale point. At the minimum, it should be a scale point. Now that high gets taken, and let's see what price continues to do. It pivots back pretty hard actually, and breaks all these lows. Now maybe you take a short somewhere up in here, and you have the expectation of this low, 64% probability that this low gets taken. When price comes down and takes that low, it completes out the engulf, right? So we go and we take the high, 80% probability that we'll take the low or the high. We take the high. There's now a 64% probability that we're going to come and take the low, and we end up taking the low. Now both sides are done, and from a sessional perspective, a probability perspective based off sessions, that the stat is over. There's nothing else to trade. You could utilize different days, higher time frames, yada yada, but from this particular stat, just looking at Asia, London, and New York sessions of points to trade to, there's nothing left to trade. This day is over relative to this stat. So if you caught the long to the high and then the short to the low, great, you're done for the day. Whatever happens the rest of the day, you're not interested. Again, if specifically using this stat. All right, now going into a different day. Let's see if we can find a... that just doesn't happen often, 7% of the time, so not really going to bother with trying to find one of those. But partially engulfs upwards. There should be quite a few of those. Here's a partially engulfs upwards. So that's what you would see going into the 8 o'clock New York session start. Price has been trending up recently. Pivot down, trends up, pivot down, trends up. And you get a partial engulf upward. So you get this. Now you have a 78% probability of taking the high, 63% of taking the low. So what that means is 78% probability of taking this high, 63% probability of taking this low during the New York session. New York session opens. There's your open. And again, entry model, whatever the case may be, however you trade. Price pivots down, forms a pivot up, yada yada, and takes the high. So now the high is out of the way. That had a 78% probability of getting taken. Now, what about trending back down and taking the full engulf, right? The full low. So again, looking at the stats from the last 10 years, we've already taken the high, so this is out of the way. There is a 36% probability we're going to take the entire overnight session, right? So it fully engulfs both sides. Low probability of that happening. That should not be the expectation. There's a 54% probability that we're going to take the Asian low, but we've already taken the high. So all that's left now is potentially taking the London low or the Asian low for a full engulf. London low has a 63% probability. So we've entered, we got long, we ran it to this high, 78% probability. Now the market's trading, continues to trade up. Big pivot back down. And let's just say maybe you got, I don't know, maybe you got long or short rather, somewhere up here. Price is trading down, and you have a 63% probability that this low will get traded to. So if you're short, right, this low should not be your final exit target or overall target. You should likely be targeting this low because of the 63% probability of it getting tagged. Take into consideration also the noon curve factor here. If you're not familiar with the noon curve, go look at that stat in that video. But you have noon curve right here, so if you're expecting highs or new lows, whatever the case may be. But again, price starts to trade down and takes out the low. Now, from a probability perspective, the day is done, right? So we've taken the two high probability targets, 78 and 63. We're not expecting the Asia low. That only has 54. And to take the Asian low would mean a full engulf, and that's 36% probability. So going into the rest of this day, you're not expecting this low. Low probability that this low hits. It ends up hitting, and sometimes that happens. That's why the probability is, 36%. It's not zero. It happens 36 out of 100 times. So it does happen on this particular day, and that closes out the session. Let's see if we can find just maybe one or two more examples. Here's another example of partial engulf up. So price is uptrending, coming out of session open down. We save the low, save that low, price uptrends, pullback, new high, higher low, and you're going into New York session. So into New York session, the probability expectation is 78% probability that this high will get tagged, a 63% probability that the London low will get traded to, and a 54% probability that the Asian low will get traded to. Now what happens? New York opens up, it runs a little bit high, it pivots down, and just goes and takes, that's the 930 open, so that makes sense, that big volatility injection. But again, it just goes and runs and takes the high. So now that high probability, 78% probability target is out of the way. We've now taken that. It's no longer a target. Now there's only a 63% probability we come back and take this low. Not super high, but better than a coin flip. Based off of the uptrend, you might not be expecting or considering that would happen. So price trades down and then just rockets up. There's the rest of your session. But that was your high probability target right there. And we'll look at maybe one more example of see if we can find oh, there you go. There is a London gets engulfed by Asia. So this exact example where London trades inside Asia, it only happens 7% of the time historically over the last 10 years. Not something you would really expect to happen. But if it does, the probabilities Our New York will take the Asian high. So let's go right there. New York will take the Asian high, so this high, 74% of the time. It will take the Asian low 63% of the time, and both sides 42% of the time. So New York session opens, does a little, you're already in an uptrend, right? So coming into this low, higher lows, pivot down, new high, and another pivot down. So you're already in an uptrend of sorts. Coming into the New York session, you get a pivot down. Perhaps your entry model triggers you to go long some point in that price movement. Now you're long, and now you have an expectation of a high, and that high gets ran. 74% probability that that high would get ran. And that's your Asia engulfs London. Look for one more example of a downward. So there's your downward. The high probability would have been the low, right? So when we're looking at partially engulfs downward, 82% probability of the low, London low, 58% London high, and then low probability for the rest. So going into this was an outlier day in terms of probability. The expectation would have been the low, but the low did not get tagged. And then low probability for the rest of those targets. One more example, there's an internal London engulfs up. So here's an engulfs down. That low gets taken, but not much of a way to get short on that. It just kind of fades out once 8 a.m. opens up. So not really a good example, even though it works out, but just not a good example of beneficial for a trade. There's another one, 8 a.m. opens and just kind of fades out and takes that high probability low. You might not even have been able to get short on that move. Let's see if there's another one here. That one takes both sides, and there just might not be another one. That one again opens up, fades, takes that low, high probability low, high probability low. Is there any one that just pivots up for a nice short entry? All of these immediately take the low. They're validating the probability, but they're just not giving an entry. That one misses it. And maybe this one, right? This is the only example I've been able to find where it gives a pullback up before more down. So all of them were taking that high probability low, but just not really giving much of a way to enter. But again, looking at the stats, London partially engulfs downwards. So what's the probability? What's New York going to do? New York will take the London low, blue box low, 82% of the time. It will take the blue box high, London high, 58% of the time. And then the rest you would not expect. Those would be logical areas to not think price would go to, thus avoiding or taking off the trade in profit before those targets. So as you go into the New York session, you're already in somewhat of a downtrend. Lower high, lower low, lower high, lower low, lower high, etc. You're already in a downtrend, and New York session opens up. It pivots up a little bit. There's your pivot up a little bit, runs out this high, does not take this high, and perhaps there's some type of divergence here with ES, something like that. I mean, I don't really know. However you trade your entry model, but you have a probability perspective of this low getting taken 82% of the time historically, given this pattern. So if you get short up here somewhere, you have an 82% probability that this low will get taken. Up in the 800s, 820s, down to this low 750s. That's about 50 points or so of profit. Good trade, good short, and price ends up taking that low. So that is how you could utilize that. It's just a expectation. So where price was, what pattern it created, probability of those highs and lows getting taken to be a confluence or validate your bias of short or long. That is how you use ALN Sessions. If you have any questions, feel free to let me know. This can be combined pretty well. If you look up the RTH breaks, initial balance breaks, noon curve, other probability concepts that revolve around time. If you look up the price and time, if you look up those all mingle well with ALN Sessions. It can help provide double confluence, triple confluence for a specific price point getting taken, right? So if you're already going into the session with an 82% probability expectation of this low getting hit, perhaps the initial balance, that 9:30 to 10:30 window of time, you're expecting the low to get ran, which would, help with this, or maybe the RTH, if we open up internal, right? So here's prior days New York session. So if we price opens up internal to the prior day New York session, prior RTH, if price opens internal to that, then you have that high probability expectation of one side or the other getting ran. The logical closer side would be the low, right? So opening up internal, it's being that if you're looking at, where are you closest to, where's the path of least resistance, you're in the lower portion, the lower quadrant of that prior RTH, it's probably likely to assume that the low will get ran. You're also assuming that the low will get ran on London for the ALN sessions. Maybe initial balance is showing you that the low might get ran too. So those are ways you can have kind of double, triple, quadruple confluence of a specific price point getting ran. That's how you use it. Again, if you have any questions, just feel free to let me know, and have a good day.